Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, Chuck Self is back with us. He's the Chief Investment Officer with iSectors. We're going to take a look at attractive tactical asset allocations for the remainder of 2019 going to 2020. Chuck, it's great to have you back with us. As always, before we get into some of the areas you're looking at, tactical and asset allocation strategies, it's very rules-based.
Correct.
What does that mean?
Well, most of the time, people are not, in this day and age, trying to do tactical asset allocation between sectors or asset classes based on how they feel about the market. Usually, it's very quantitatively driven at this point, using historical information and determining what factors are most likely to move different asset classes. And so the good news is that we're taking the human aspect out of most of it besides the design of the tactical allocation strategies. Just like behavioral finance has taught us that human beings are not very good at making these kind of decisions. And so using the data that is out there, coming up with the allocations that are most likely to be successful in the future.
And if they are managed successfully, that can minimize downside risk while participating with the upside to the market.
Yes, and that's the whole point of it. And certainly in the iSectors allocations, our whole goal is to minimize downside risk and then just let the market do what it does. And our experience over our 15 years is that if you minimize downside risk, you'll outperform the market over time.
How come there's such a wide range of performance with different assets?
Well, there's so many different ways of being able to create these tactical asset allocations. You always have to have a defensive sector to go into when you don't want to be in stocks. Over the long term, stocks are the best asset class. But the whole point of tactical asset allocation is not to be in stocks when you think there's significant downside risk. Unfortunately, the industry standard has been to go into cash. And as we know, cash has low interest rates, actually below inflation. So as I say, cash is trash. And what we try to do is find other asset classes that will usually perform when stocks are not performing. And once we use our long-term treasuries and also precious metals ETFs.
Yeah, I was going to ask you that. Are you seeing asset allocations go to more alternative type of investments these days?
Yeah, and you know, the long-term treasury is still always a great alternative. But again, interest rates are low, and even with the recent increase in interest rates, they're still relatively low. So we also use gold miner ETFs as another alternative, again, looking at the historical record and see when it's the best time to use them. But another thing that a lot of asset allocators get wrong is that they're only using one or two different factors in determining the asset allocation. Maybe they're just trend followers, or they look at volatility. We use over a dozen different factors, both economic and market oriented, in order to figure this out, because if one factor goes wrong and you only have one or two factors, then your whole tactical allocation goes bad.
Especially trend and volatility, they could change on a dime, particularly in this market.
Well, they certainly have this year, and that's one of the problems this year, and especially for those people who determine to rebalance based on those trends or that is going on in the marketplace, because they've been whipsawed often this year. We end up buying high and selling low. And so one of the things that we do is we just have a set time every month that we look at the markets and using all the different factors determine that what the asset allocation will be. So we're not as reactive to the market and have less likely to be whipsawed.
Well, we have less than 2 months to go into the year. Seasonality, it's typically strong.
Positive.
Do you think, what are your thoughts into the end of the year?
Well, certainly, as we've seen, the market has done very well, and I think the positive seasonality has worked well. Earnings are better than expected, but I don't think that the market is still focused on that. We're going to have year-over-year negative earnings for the third quarter numbers. I mean, I think we're 85% plus done, and it looks like that's the way it's going to be. And very well, we could have it in the fourth quarter. And so we are still cautious on the market. We're especially cautious on the market now after this run up. Interest rates, relatively speaking, are more attractive than they have been recently. And we think that precious metals especially and gold are in this positive cycle with low interest rates and nowhere else to go where there's great valuation. If you look at the Dow to gold ratio and so on, gold still has great valuation, and investors should have at least some part of their portfolios in that asset class.
All right, Chuck, great to see you as always.
Thanks
Thanks for
Jill.
joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.